Alright guys, welcome back. Patrick here. Are you ready for me to show you something truly beyond scary? Something that will rock you to your core? If you have kids, you probably want to cover their eyes right now because might not be suitable for YouTube. Well, here it is. We've got the Russell 2000 chart for 2021. Year to date, it had been doing okay. I mean, we had that channel that kept on going. We had some ups, we had some mini crashes, but overall, at least we were stable until October, where we actually broke out. We were making good profits. And then we saw this collapse of epic proportion, which has been a total bloodbath. I don't know anyone that's been profitable over the past 2-3 weeks. Almost everyone lost months and months and months of profits, and now we are at the bottom of this range. This is truly scary. So in this video, we are going to be talking about like what's going on, and more importantly, is now time to buy like some of the YouTubers are telling you, or should we panic because there might be even more pain coming? So let's dig into it. I'll give you my opinion and what I'm personally doing. Alright, we have a few things to look over today. First, remember on Thursday I said we might not have seen the bottom yet, so be careful. Well, sure enough, on Friday we had a pretty tragic day where literally everyone probably lost money because there were only one or two industries that were up, mostly defensive stocks, and that's not what the retail trader usually buys into, right? We're more into growth stocks, and those got pretty much all got hammered on Friday. So now I'm hearing a lot of calls about going all in on the market and like buying heavy and everything, and there's some merit to that. Of course, the prices are much lower now, much more attractive. We'll look at some of them later on in the video, but overall I want you to be careful and stay disciplined, right? So don't follow the dum-dums on YouTube that tell you to buy at any cost. They're the same people that were telling you to buy DraftKings over $60 and now it was going to make you a millionaire and it was a 10x play, right? So I urge you to be cautious and think for yourself and look at these numbers. Now, December is traditionally a good month for the stock market. That is correct. That is historically a fact. If you look at it since 1950, there's been 53 up years, 18 down years, and the average return is up 1.39%. So overall, December is a good month for the stock market, but not always. Look at 2018, which was a catastrophic year for the market, down 10.16%. If you look at some of the headlines back then, US stocks post worst year in a decade as the S&P 500 falls more than 6% in 2018. So December is not always a good month, right? It is true that overall there is going to be probably a rally, but look at how eerily similar this chart from 2018 is to the current one in 2021. So look at how until September it had been an uptrend and then start to fall and fall and fall, exactly like it did this year, except this year was kind of delayed to the end of October. Now, if we use the current date, right, I'm filming this during the weekend, we would be around here, right? So notice how in 2018 there was still a lot of downside left after the first week of December. It fell and fell and fell and crashed all the way down here, which basically bottomed right before Christmas, which is typically where you hear the expression the Santa Claus rally. Well, in 2018 it's after Christmas that look at how it gapped up, and then you had that very nice rally into January. So this is kind of what I'm hoping is going to happen this year. So I would not be surprised if next week it continues to go down, and the week after there's still going to be people that are going to be tax loss harvesting. There's still going to be people, if they still have profits, that are going to be taking profits. People are still going to be like jittery and everything. So overall, I would not be surprised if there is more pain coming. With that said, there are two different ways to buy into the market, and that's what we'll look at, right? Because if you look at 2018, yes, look at the recovery, right? Yeah, it rebounded to where it was a month or two before, but look at how long it took to reach the plateau here, or rather the peak that it had established in September. It took all the way down to the end of 2019, beginning of 2020, before the pandemic hit, and we hit another like fall off a cliff here. Right, so it took a long time for the market to go back to the peak, and that's what I'm actually fearing right now, is that we had broken out. Now that we're back here, well, let's say that we see a rally in January. Where are we actually going to get to? Are we going to go back up to like here, this peak, or are we actually going back to the peak of 2442-ish on the Russell 2000. I tend to think that we might actually be hitting this, possibly if we do get a rebound. With all that said, even though I do urge caution, it's undeniable that some of these stocks are much more attractive than they were before. I'm going to use the example of SoFi, which pretty much every viewer is probably interested in SoFi, so let's use that one. Well, the company now is very different than it was in the summer and in the spring when it was around these prices. Look at how during the summer after Q2, it actually dropped to $14. While now, as of me filming this, the stock is at $15. So if you thought that you missed your opportunity when the stock went up to $23, well, now you have a second chance, right? It's like we reverted back in time. We took a time machine and now you can actually get into it at a decent price once again, knowing that the stock has gone to $20 a few times before, which means that it probably will again in the future at some point. The company is not going bankrupt anytime soon. In fact, if you look at the numbers, the company is a lot better now than it was just a few months ago. Look at this. This was the revenues in the first quarter, 216 million. Well, now we're at 277 million, right? So you get pretty much 25% bonus for the same price that you would have paid a few months ago. And you saved yourself 6 months of waiting with no returns. Now, if you look at the members, now we're at 2.9 million. Well, in Q1, they were at 2.2 or 2.3 million, right? So that has gone up a lot. The Galileo accounts, which is their technology platform, we went from 70 in millions to 89 millions. Right, so you get a big benefit now buying into SoFi, for example, compared to a few months ago. Like the company has improved, even though the share price has stayed flat, or in some cases come down since before. Right, so if you're looking for a company like this, there is a case to be made where you can actually buy into, but there is a big mistake that people do, which is what I want you to take from this video. So objectively, there are a lot of stocks that are becoming more attractive right now as the prices are pulling back, and I have personally started buying into some of them once again. Now, there are two different ways to buy, and I feel like a lot of people are making a big mistake. The first one is what you hear a lot about, which is dollar cost averaging over time. That's what Cathie Woods does. So let me give you a very clear example of this. If you look at ARK, right, and their investment in Unity, which is a company that I am personally interested in, I've been looking into for a while, well, they buy and sell pretty much every couple days for months, if not years at a time. So over time, their cost basis is going to be an average of like the fluctuation of the prices every day over a long period of time. Now, the big mistake that a lot of retail investors make is that they see like the price has fallen a little bit, right? Let's say when SoFi went down to $18, they're like, oh my gosh, it's so cheap. So they go heavy into it. They buy their entire position, and then the stock keeps going down and down and down. Let's say it goes to 15. Let's say it goes to 14. And then they don't have any money left, right? So they're not averaging over time. They do one big purchase in a downtrend, and then they're stuck back holding for weeks, months, years in some cases. I mean, you guys know, you might have some in your portfolio that you did that earlier this year with SPACs, right? You're not buying into them right now to dollar cost average down, even though they're at a discount now, because you're afraid to buy more since the stock has dropped so much. So that's the first method of entering into positions and accumulating. It is dollar cost averaging down. If you want to do that, you have to be very disciplined and you have to have cash behind you to back up your position, right? So if the stock keeps going down, let's say SoFi keeps going down over the next month, right? It can go back to 13. Nothing stops it from doing that. Well, if you want to buy next week at 15, then you have to be ready to buy at 14. You have to be ready to buy at 13 to defend your position. But what if you don't? What if you have a smaller portfolio? You're not as disciplined. Well, then you have to rely to timing the market. And this is why I actually made the video, right? I personally like to do that. You want to wait until the stock bottoms out like it did here and restarts to go up, exactly like it did earlier this year after Q2. When you see the stock starts to have momentum again, then you're going to be loading up your shares. You're going to be buying your 1,000 shares or whatever you're going to do, and you're going to be riding that wave up. most people are not good at timing, right? They're going to be buying at the wrong period, like now when it's going down, and they're going to be stuck where when that momentum comes back, they're just going to be breaking even. So as I alluded to earlier in the video, I personally started buying a little bit on Friday, nibbling as we call it. So I bought a little bit of SoFi, I bought a few other stocks, and over time, if the market keeps dropping, I'm going to use the first strategy I told you guys about, which is to dollar cost average down. But that's only because right now I do have cash to back up my position, right? So I can buy a lot more if the price goes down than what I have right now. But that's not the case for every stock. Let me show you another one, right? So this is SoFi, as I mentioned. If it keeps going down, I can dollar cost average down. But companies like PayPal, where if I want to buy at least 100 shares, it's going to cost me 18,000 bucks. Well, this one, instead of like buying now and averaging down, which I won't be able to do, right? I can't put like hundreds of thousands of dollars into PayPal. So what I'm going to do with this one is actually wait until it bottoms out and it starts to go up. That's when I'm going to be buying into PayPal. So it was kind of funny. Like I use him in videos all the time as I reference, but one of my friends was like, hey, PayPal's up $4 or $5. Did we miss it? And I'm like, dude, there's like 50 up days left before the stock goes back up to 310. We didn't miss it, right? So if it goes up to 185, then 190, 195, then it's going to be a fine time to buy into PayPal as it keeps rising. If it makes it to 195 or 200, it's going to make it to 225 and 250 over time, right? So you have to like stay disciplined, stay rational. Don't go all in yet, in my opinion. Be safe, and I'll see you guys in the next video. Link in the description, of course, for Discord and Patreon. WeBull, that really helps if you guys want to support the channel. See you guys later.